Reality bites. That's what happened overnight. Markets, which have done a remarkable U-turn in the 24 hours over the Monday trading period, having sold off initially in response to the escalation in the Middle East, and then bouncing back before the end of each session around the globe, we saw investors finally really take reckon of the potential inflationary effects of this escalation in the Middle East. And a lot of it is focused around the potential for much higher energy prices and the impact that's likely to have on inflation around the world and what that means for central banks and governments as they formulate their policies. Of course, a tighter monetary policy environment is a concern for every investor. And we saw that reflected in overnight trading. European markets were hit very hard, down 3 to 4%, most of the major indices there. And that negativity spilled into US trading as well. The NASDAQ, the S&P 500 down by 1%. And of course, that followed a weekday's trading in the Asia Pacific region, where we saw the Australian share market down about 1 1/3% and the Hang Seng down just over 1%. So it does appear that investors are finally taking seriously the implications of this escalation in the Middle East. And the most glamorous stocks, those high flyers that have been so popular for so long, that have been trading at very lofty valuations, were the hardest hit. SanDisk, one of the best performers last year, up by more than 500% and showing strong gains in the first 2 months of this year, was smashed in overnight trading, down 8.7%. We did see a bit of a rotation effect. Investors didn't appear to be leaving the market entirely. And some of those software stocks that have been hit hard previously in concerns that artificial intelligence might cut their lunch bounced back. And Workday, for example, was up 7% yesterday. But some of those resource stocks that were initially favoured due to the escalation in the Middle East gave up a lot of their gains. And a lot of that had to do with the price of gold. Gold fluctuated through an almost $400 range overnight. It almost got to $5,400 before almost touching $5,000 and finishing down for the session. And that negativity in the gold price was reflected in the gold miners. Newmont, one of the leaders of the globe in terms of gold mining, down more than 7%, as were some industrial commodity stocks like Fortescue, also down more than 7% in trading yesterday. So that weakness in metals was surprising, particularly given the price of oil bouncing by another 5%, adding to previous gains. But in a sign of real concern from investors, the VIX rose again. Now, having lifted over 20% in trading on Monday, it rose again in overnight trading. It's now sitting around the 23.5% mark, and a clear signal from the Fear and Greed Index that fear is on the rise amongst investors. The US PMI was up, but I think that was washed away with the macro news flow. We do have GDP out in Australia this morning, expected to show an annual growth rate of 2.1%, up 0.7% for the quarter. Now, if we were to see a large divergence from that, if growth were a lot stronger than expected or a lot weaker than expected, that might have implications for interest rates. However, the sticky inflation, the higher levels of inflation mean that it's unlikely to move the dial. Perhaps more important today, we've got the China PMIs, services and manufacturing. This will give us a good read on one of the globe's largest economies and Australia's largest trading partner, so it could be important for the local share market. And the earnings season rolls on in the US. There's another 50 companies or so reporting tonight in the US. One highlight will be Broadcom reporting tomorrow morning after the US close, one to watch out for. But at the moment, the markets are all about inflation, and the global growth fears are paralleled by concerns about price rises. Now, this is the poison for investment. Rising inflation and slowing growth can lead to what economists call stagflation, the worst of all scenarios for markets. And that is the concern here, that the break on global trade that could be introduced by Iran's blockading of the Strait of Hormuz is a real concern, because not only will it impact growth outlooks, particularly for Asian nations who get a lot of their oil from the Persian Gulf, but also the inflationary impacts on energy prices could mean that we get the double whammy. And that's what investors appear to be reacting to here. And the danger for markets and economies is that that rising inflation rate means that neither governments nor central banks will be able to help in terms of supporting growth if inflation is on the rise, because stimulation via lower interest rates or fiscal policy just adds to the inflation problem. So we're heading into a tougher period for markets generally. Central banks certainly won't be riding to the rescue if we see sell downs, and investors appear to be pricing that risk now, having ignored it largely in the buying that we saw on Monday. So we could see further selling pressure, given that the markets have been focused on potential rate cuts in the US. That is now receding, with a lot of analysts now moving away from that idea. Interest rate traders have pushed back their pricing. They're not pricing a rate cut in the US fully until September this year. And by the end of the year, they're not fully pricing 2 interest rate reductions. So that's a big change from the 3 interest rate cuts that markets were expecting just a few weeks ago. It's a similar situation here in Australia. The RBA Governor, Michelle Bullock, has said that this March meeting, March 17, is live. In other words, there's potential for a rate hike as soon as 2 weeks' time in Australia. Now, that's not what the market was expecting. Previous to that announcement, the market was predicting around a 17% chance of a rate hike in March. That's now gone to about a 1/3 chance, a 33% chance of a rate hike as soon as March. So one to watch out for in Australia. Now, responses in markets to interest rate hikes are harder to predict. Generally speaking, interest rates are going up when growth is accelerating. But if growth is not accelerating, and the reason rates are going up is inflation, then that's more likely to have a negative effect on asset prices generally and share markets in particular. And given that the Australian share market is near an all-time high, this change in perception around inflation and therefore interest rates could see some profit-taking move into the market. We might see further pressure on the Australian share market today and in the coming days and weeks. There has been some talk amongst professional investors talking about the smart investors will buy when retail sentiment collapses. And that's a very cynical view of the markets, but nonetheless, it does appear that a lot of professional investors are stockpiling cash at the moment in anticipation of a repricing of risk generally and a repricing of share markets in particular. However, the world marches on, and so do the results. Turning to our watch list today, top of the list, Palantir. Now, this is one of the good proxies for sentiment around the Middle East escalation because it's reversed previous weakness. It's been falling for a few weeks now. It's up 15% over the last 2 weeks. And the reason appears to be, for the latest leg up, the defence ties that Palantir has through its software programs. So fourth quarter revenue due soon is expected to lift by 70% due to its engagement with the US government. If that does spread to an international engagement, there might be further earnings upside for Palantir. That's certainly the liveliness of the share price recently suggests some investors are thinking that way. A number of analysts have a buy on Palantir shares and target prices for Palantir are being lifted as we speak. Another beneficiary of the escalation in the Middle East are uranium stocks. It was one of the best performing subsectors. Despite the weakness in the Australian share market yesterday, the uranium subsector was up by more than 1%. Now, NexGen is an Australian-listed Canadian uranium explorer. And it's got its results coming out this morning. It's already up 31% year to date, and it is advancing the world's largest high-grade uranium project. So there's been plenty of interest in this stock already. It was added to the ASX 200 in December and has now completed a $1 billion raise in equity. A number of analysts also have a buy on NexGen shares, and the uranium sector does appear to be one of the major beneficiaries of that big lift in energy prices brought about by the US and Israeli actions in the Middle East. And third stock on our watch list today is BYD, the electronic vehicle manufacturer. Its sales fell 40% in February, mainly due to lower demand in China. It was the world's largest producer of electric vehicles, but that fall in demand is imperiling that stance. Production is about 50% of capacity at the moment, and it's now being outsold in China by Geely. Its shares are down 40% from a May high, but a number of analysts have a buy rating now that it has been so reduced in share price. Target price is once again being reduced, but still well above the current share price of the BYD.